Welcome everyone, and I hope that everyone is doing well. Thank you for joining us today, for being a client and a friend of the firm. I'm going to dive right into the outline around some aspects of the 2020 CARES Act and frankly the 2020 economic conditions that should be considered when putting together your year-end tax plan, as well as some impacts from PPP loans and the new Maryland pass-through entity election. After I babble for about 15 minutes or so, my partner James Eaton will address some specific year-end planning strategies, and my partner Michael Bondi will discuss issues facing C corporations as well as some international tax issues some of our clients should be aware of. So the first item from the CARES Act, if you have a 2020 net operating loss, which may be more common than in a normal year, you may choose to carry that back 5 years or carry it forward. This was something that was put in place in the CARES Act back in April, and you also had the ability to carry net operating losses back that were incurred in 2018 and 2019. So make sure that if you have a loss from a business or a business loss that flows through to an individual, you're capturing what will be a one-time opportunity to carry the loss back and generate cash refunds. In a related FYI, SC&H has been filing claims this year for 2018 and 2019 losses, and we have noted that it has taken quite a while for the IRS and states to process. And by quite a while, I mean 4 to 5 months. We continue to follow up. It's been a little frustrating, but it's still worth doing almost all of the time. Excess business loss provision from the Tax Cut and Jobs Act, that was put in place to limit the benefit of business losses to offset investment income, wage income, etc. That limitation is suspended for 2020. In 2021, the limitation comes back into play, and with a couple of changes. One, wage income will not be deemed business income, while gains from the sale of business assets will be considered business income. Two big changes to keep in mind for 2021, but for now, that limitation is suspended, which should help clients that have substantial business losses, probably due to COVID. Business interest expense, another piece of legislation that came to us from the Tax Cut and Jobs Act that was modified by the CARES Act. Code Section 163J limited the amount of business interest that many business entities could deduct. The new limit was 30% of adjusted taxable income. I won't spend 10 minutes defining that, but it's taxable income, add back depreciation, interest, taxes, amortization, essentially EBITDA. For 2019 and 2020, the CARES Act increased that limitation to 50% of adjusted taxable income. Further, in 2020, taxpayers may elect to use 2019 ATI when making their calculations for their 2020 tax returns, if you're going to get a higher deduction. And finally, partnerships have special rules, as always, where just for 2020, partners who have suspended business interest from investments they have in partnerships that came from 2018 or 2019 may deduct half of those carryover amounts in 2020 without limitation. Qualified Improvement Property, or QIP, as we say in the biz, the CARES Act provided a long-awaited technical correction to the Tax Cuts and Jobs Act, where business investment in real property that is for the interior of non-residential real property is now 15-year property instead of 39, and also eligible for bonus depreciation, which is very helpful and allows you to essentially expense that spend in the year you make it. One caveat, taxpayers who are in real property trade or businesses who have elected out of the business interest limitation code section 163J regime may find themselves unable to use bonus depreciation on QIP. though there still could be a benefit from a cost segregation study and making sure that that property is properly depreciated. And then 2020 economic conditions and other nuances from 2020 may impact, standard year-end planning. Usually this time of year, the tax partners at SC&H are advising clients on how to defer income from year one, this year, to next year. And often that's a great strategy. This year, there are a number of factors, some going in a different direction, some going in the same direction. So we'll walk through those. So first, if 2020 finds your business having a down year and you expect things to get better in 2021, perhaps deferring income into a better year is not the best strategy. If in 2020, your business income is going to push you down into lower brackets, you might not want to defer any income at all. In fact, you may want to accelerate income, as we discussed previously. If you believe tax rates might go up in 2021, same answer. I can't imagine there's anyone who thinks tax rates are going down, but it is far from a foregone conclusion that they will go up. However, that is one factor that might cause you to not defer income into the next year. Something that goes in the other direction, if you are going to lose deductions due to the IRS ruling on PPP related expenses, after you determine which tax year that impact might occur, this could impact your planning as well. In other words, if you do believe you're going to lose deductions, which then increases your taxable income, what bracket does that put you into? And then do you go back to the drawing board trying to defer income into 2021? For this year, we have clients all over the place in 2020 compared to 2019. So there is no one size fits all for sure this year. You've got to look at this year and next year and do all that math so you can have the best plan. If we go to the next slide, we're going to talk about the Maryland pass-through entity election. This topic should provide federal tax relief to Maryland owners of partnerships and S corporations, or PTEs, that do business in Maryland. As we reported on a couple of times during 2020, Maryland passed legislation this spring that allows Maryland pass-through entities to elect to have the owner's tax on business income paid and deducted at the entity level. Due to the Tax Cuts and Jobs Act, state and local tax deductions are now limited to $10,000 for an individual taxpayer. So essentially, the state tax on pass-through business income disappeared for most of our clients. Maryland's law, which was SB 523, became law in May. It actually wasn't signed, was an attempt to create a workaround for Maryland resident business owners. Just about a week ago, the IRS came out with a ruling just in time for this webinar that blessed the strategy that Maryland has co-opted from other states. So there was some concern amongst the CPA community that because this is an elective tax as opposed to a mandatory tax, that could create risks that the IRS would not follow what Maryland put out in front of us, and that risk has disappeared. The IRS has blessed Maryland's law. So the net benefit of this legislation would allow many business owners to save 2.5% to 3.3% of taxable business income in the form of paying less federal tax. So your Maryland tax doesn't change a penny, which is probably partly why Maryland was happy to pass this law, but it moves the deduction from nowhere to the business return, and therefore it's efficient and effective again for Maryland pass-through businesses. The election is annual. It must be made with your 2020 pass-through entity return if you want to sign up. You can sign up for 2020, back out in 21, sign back in 22. You can turn it on and off on an annual basis. One caveat, it will not benefit pass-through entities that only generate or receive investment income such as interest, dividends, and capital gains. You need to have net profit for it to be useful, and it needs to be profit from an operating company or a rental property. It also only applies to pass-through entity owners that are Maryland individuals and Maryland grantor trusts. So this limitation will constrict the number of entities that would benefit from this election. One piece of news that came out of the IRS guidance of last week was that a deduction is provided in the year that the pass-through entity state tax payment is made, which indicates to us that even for an accrual-based taxpayer, if you want a deduction in 2020, you need to make the payment by year end. Payments are made with Form 510D, and there is a box on that form that you check to indicate this payment is made relative to the new Maryland pass-through entity election. So that's the good news. It's tax, right? It's like the dentist. There's never just good news. The bad news, if your pass-through entity has non-Maryland owners, the election gets tricky. For S corporations, without going into all the details, we're not sure how this works because of the rules around S corporations requiring that income, deductions, loss, distributions, sale proceeds have to be allocated pro rata. And without getting into too many mechanics, we just don't see that it's an effective election in that space as the law is currently written. For partnerships, we think you can get there, but you will need to amend your operating agreements prior to filing your partnership return to specially allocate the Maryland PTE deduction to the Maryland residents that own the business so that the economics of the payment work correctly. Maryland legislators, if they are so inclined, could correct this aspect of the law, though we haven't heard anything about attempts or any current initiatives around this. Should we hear anything during the General Assembly session in the spring, I'm certain you will hear from us. If we go to the next slide, so PPP loans. I have not talked about PPP loans enough in 20, so we're going to do it one more time. The IRS, as many may recall, earlier in 2020, ruled that if a PPP borrower had its loan forgiven, the expenses paid with those proceeds would not be deductible. In other words, while the CARES Act clearly stated that loan forgiveness was not to be taxable to borrowers, the IRS said not so fast. While one could argue that the technical merits of the IRS position may have some validity, many would argue, including the person currently babbling, that they did not properly consider congressional intent. The furor over the ruling was loud and swift. Bills were drafted to remedy the situation, though all of them have languished since the summer. Assuming the IRS is correct, and hold on to that for just one moment, the next question is, when do I recognize income, or more accurately, when do I disallow deductions related to my PPP loan? Is it in 2020 when I received the loan and spent the money? Or is it 2021 when my loan is approved by the SBA? Some banks will approve loans prior to the end of the year, but I cannot imagine the SBA will approve any before the end of calendar 2020. Or if you have a loan balance over $2 million, the SBA has up to 6 years to audit your loan for loan necessity purposes and frankly, any other purposes. So in theory, you may not know for certain as to whether or not your PPP loan is forgiven in that situation until sometime in 2026 or 2027. If that happens to you, you may call me from while I'm in retirement and let me know how it goes. We reached out to the Associate Chief Counsel who authored the IRS notice on this issue of PPP loan expense disallowance. And her opinion was that if a PPP borrower had a reasonable expectation that the loan would be forgiven by the end of 2020, not that it would be forgiven by the end, but your expectation was reasonable at the end of 2020, then those deductions related to those loan proceeds are lost in 2020, even if loan forgiveness isn't conferred until 2021. So many businesses will recognize PPP forgiveness income in their financial statements in 2020, which clearly could create a book tax difference and an optics issue at a minimum. and certainly would be cited by the IRS as audit evidence should they examine a position taken counter to that. Many respected national commentators have used the late great Yogi Berra as a source on this issue, and they are saying the loan isn't forgiven until it is forgiven. So you don't have a taxable event for most PPP borrowers until 2021, when the bank and the SBA have blessed your forgiveness application. If that is true, then we need to figure out, do we have income in 2021? Do we have lost deductions in 2021? Or worse, do we possibly have an amended return to file for 2020? And then finally on this, or can you take a position that the IRS is wrong, they missed congressional intent, disclose that position, and file your return counter to IRS guidance on the issue? So it's a bit of a swirling mess. So what to do? First, Congress may act before we start filing 2020 tax returns. We are hearing that there will be no action on this issue until the new Congress is seated. So you're talking mid to late January at the earliest. If you are the owner of a fiscal year entity, my advice would be to extend and see what Congress has to say. It's pretty clear both sides of the aisle want PPP expenses to be deductible. They put those words into the law differently than the IRS would say, but they said that the loan forgiveness should not be taxable. Disallowing the deductions is the same economic answer. However, all that said, Congress still has to act. If they don't act by March 15th, we might be in a position where we're going to recommend extending calendar year returns until we hear from Congress. So hopefully Congress can get their act together and resolve this before it becomes too problematic. To me, the bigger issue is, how do you handle it now at year-end planning? Do you assume you get the deductions, or do you assume you do not, and in what years? I think the best strategy is to develop plans under both scenarios, where you lose the deductions in 20 or you don't, and then wait until the very end of the year to pull the trigger on which plan seems the most probable. We do have some clients who have had down years in 2020, which is very understandable. And many of them are saying, if I have to lose deductions, Jim, it's okay if it's in 2020. My revenue is down. I've had extra expenses related to COVID. This is the right year to take, have a lost deduction, if you will. We have others who think tax rates are going up, so they would rather lose deductions now than have income in 2021. Both valid strategies. On the other hand, we have some clients who probably will have a net operating loss in 2020 if they can take these deductions. So why not have a bigger net operating loss? And as I just talked about, carry that loss back to 5 years ago, then 4, then 3, and be able to generate cash, which can help you get, through the next few months or into 2021. So these are all things you have to think about. And frankly, we have some clients who have spent the PPP money, and simply cannot afford to pay the tax on those funds on top of that. So again, we hope to hear from Congress soon, and when we do, you will hear from us. A couple of curveballs for you. Maryland and some other states will likely decouple from any legislation that Congress passes. So if Congress does say PPP related expenses are deductible, that would be great. But for Maryland, it's almost certain they will decouple from that legislation and say that loan forgiveness from PPP loans is taxable in Maryland. So keep this in mind for year-end planning, especially so if you are going to be making the just discussed Maryland PTE election, because your Maryland income will be higher than your Fed, and you'll want to try to maximize that deduction. One other nuance to this mess regarding PPP deductions. So if you do lose deductions, which ones do you lose? Only the ones you submitted with your form. Most of our clients aren't giving all of the expenses that qualified under PPP because the wages gets them to 100% forgiveness. So is it only ones you submitted? Is it a portion of all of them? Do you pick and choose? And for the tax geeks still listening in, how does losing wage deductions impact your QBI deduction as it relates to the wage component? How does it impact your UNICAP and 263A calculations? How does it impact business interest expense limitations? wage deductions disallowed under 280E, 280G, or even state apportionment. Again, I'm hoping all of that nonsense can be eliminated when Congress acts, so stay tuned. Finally, turning to PPP forgiveness. Forgiveness applications have been getting submitted for a few weeks now. I just spoke with a client this morning. They submitted theirs about 3 weeks ago. We have heard from some clients where the bank has approved their forgiveness application, but we are not yet aware of a client who the SBA has yet forgiven. We're going to have a couple polling questions around those questions or those issues that we can share with the group later. So you now have not one, not two, but three possible forgiveness applications available to you. If your loan amount exceeded $2 million, you also need to complete a loan necessity questionnaire. You will receive that questionnaire within 10, and will have 10 days to submit said form upon receipt from your bank. The bank then has 5 days to submit that to the SBA. So you have the long form, and you have a short form, and you have an easy form. They're all on our Coronavirus Resource Center and the SBA website. One quick note, and we did blog about this a couple of months ago. If your business has or will experience a change in ownership while you still have a PPP loan outstanding, you need to speak with your PPP lender ASAP, as there are special rules for you to deal with. As far as PPP 2.0, again, we are hearing don't expect much action on that from a stimulus package perspective until January, once we get through the Georgia runoffs and new Congress has taken its seat. As mentioned, please keep our Coronavirus Resource Center bookmarked and check it a couple of times a week for updates on PPP loans, PPP deductions, and other tax issues that will affect you and your business as we head towards the end of 2020. With that, I'm going to wish everyone well, and we will go to polling question number 3, and then let James Eaton discuss his thoughts on detailed year-end planning ideas. So has your business applied for a PPP forgiveness yet? Please check yes, no, or didn't apply, and then we can take this in our next question and give people some live data on how that process is going. Thank you.
Super. Well, I think that was great information, great feedback. I will say, for me, I was a little bit surprised. We've seen maybe a plurality, about a third of folks who have already applied for forgiveness, and based on that survey, I think a lot of folks are saying, hey, I'd like to better understand these rules before I apply for things, and some of the knock-on effects as well that Jim just outlined. So that's really interesting. Let's talk about, for a few minutes, what I'll call traditional year-end planning. Things that we might normally do as we approach year-end for tax purposes. Oftentimes, a talk like this can spend a fair amount of time with respect to cash basis taxpayers, and that's different than accrual basis taxpayers. A little bit of ambiguity there comes in when, hey, I keep my internal financials, my daily, monthly kind of reports on an accrual basis, but then, hey, I'm taxed on a different basis, and that means we have to do some analysis at the end of the year. So traditional tax planning techniques for cash basis taxpayers include sort of two things. Delaying receipts, interesting idea, and accelerating deductions. The easier of the two to think about is probably accelerating deductions. So do I have any bills that are due in the early part of January that I can go ahead and drop in the mail in December? And so the IRS has sort of the old mailbox rule that says, interestingly, if I write a check on December 30th and I drop it in the mailbox, the check doesn't have to clear, it doesn't have to be delivered to whoever the recipient is traditionally I can deduct that as long as I've put it in the mail. So it might take a week before it clears. You're still entitled to that deduction. What are some common areas where we see folks taking advantage of that? Rent is maybe one that jumps out, right? That's going to be due on a monthly basis, and it's due sort of a set known amount oftentimes. So if we can pay January's rent, in December, that might make sense. Things like utilities as well. We also look at salaries and bonuses and commissions, compensation. There was an interesting scenario, I think, a few years ago where, and I guess it happens every few years, where December 31st was on a weekend, and you said, well, let me see, should I hold off on making the paycheck? Should I go ahead and run my payroll? Well, if you run that payroll on Thursday or Friday and you get the paychecks out the door, then we got to take a deduction in a given year. So those are the types of things that we look at as we approach year end. The other part of that equation is, at least conceptually, a neat idea is, hey, let's delay cash receipts. So let's just say that your business existed in a world where you knew that you were going to get paid 30 days, right? Out goes the invoice, 30 days later, in comes the payment. And instead of, in that scenario, billing your clients, in November right after Thanksgiving, you might wait until the first week of December. And in that way, you've delayed the collection from right at the end of the year, between around the holidays and the end of around New Year's Eve. You've actually delayed that into the next year, and you can delay the picking that up in income on a cash basis. It's a great idea in concept. It's tricky in practice. Number one, we don't necessarily always have a direct correlation between the date that the invoice goes out the door and the date that the cash comes back in. Equally, especially in today's world of uncertainty and all the things that we deal with, delaying cash flows and holding off on billings is maybe not something many business owners feel comfortable with. So business owners may well feel that the bird in the hand is better than one in the bush, and go ahead and bill whatever they can and get the cash in. In addition, with respect to both cash basis taxpayers and accrual basis taxpayers, asset acquisitions and accelerated depreciation have traditionally been tools that are used at the end of the year to manage taxable income. So we say, hey, I'm going to have, according to my projection here, I'm going to have $100,000 of taxable income. That's great. And I need a piece of equipment, whether that's a server in a more IP-based workspace, or I need a big truck or some kind of piece of yellow construction equipment. And if that's a $50,000 or $100,000 piece of equipment, and I know that's a revenue generating piece of equipment, then I can go out and I can buy that. As long as it's placed in service by the end of the year, I can, at least conceptually, accelerate my depreciation deduction. So in that scenario, I've got $100,000 of taxable profit. I know I need a new large heavy duty piece of equipment. I'll go out and buy the equipment, and I can take that $50,000 or $100,000 of deductions and actually take those depreciation deductions in the current year, knock down that taxable income. Interestingly, or from a sort of cash flow perspective, that depreciation analysis still works even if the acquisition is financed. So if we take an example of a piece of equipment or a big heavy duty truck of some description, we've got that $100,000 of profit. We say, hey, I'm going to go buy a $50,000 truck, so I'm going to knock my profit down to $50,000 for this example. I can actually do that with very little, or maybe even zero, cash outlay, because I can get financing on the equipment. I can take dealer financing on the truck, and so I can actually have the cash in my hand, knock down the taxable income, and that's sort of a traditional something we look at. Some things to consider during 2020 for companies that have had a less than ideal year would be that to keep in mind that Section 179 accelerated depreciation is on an asset by asset basis. So you can walk out into the parking lot and say, okay, we're going to 179 that truck, but not that crane, and you can look at things that way. But equally, Section 179 cannot be used in a loss scenario, so it can't be used to extend a loss. So if you're in a loss situation and you want to use some of those techniques that Jim outlined for us as far as carrying back NOLs, you can't use the Section 179 to expand a loss. However, you can use bonus depreciation, which is great. That's another, again, 100% acquisition cost recovery. But bonus depreciation is actually allocated on an asset class by asset class basis. So in that scenario, you might look and you might say, hey, I've got 3 trucks, and where I might want to take the accelerated depreciation on just one of them, when I'm in a bonus regime, a bonus depreciation regime, I have to do it by asset class. So now I'm going to have to accelerate the depreciation on all 3 of these trucks in this fictional example. So in a scenario where business isn't as profitable as it has been in the past, while the same tools are available to us as a business owner, we might use them differently. So let's look at the next slide. So if we look at that, we say, hey, should our general year-end planning be reevaluated? I think we've heard a couple of times about what may happen in the future. There's lots of ambiguity there, but if ordinary income tax rates are higher, and if maybe qualified dividends or capital gains tax rates are higher, then what does that mean? Maybe I don't want to accelerate my deductions. Maybe I don't want to delay my income, especially if 2021 sounds like a better year. Thanks, Jim, for explaining that. Those are the things we want to think about. We're also in a scenario where we're gonna say, hey, what if the QBI deduction is not available to me in the future? I may actually want to have a higher income year for 2020 so that I get to take advantage of that, at least conceptually, 20% deduction. So that's really important. We've also had some clients that look at what does 2020 look like, and they just saw some seasonality in their business. They said, hey, you know, February and March and April, maybe May, were down years, but we came charging back in the second half, and the year looks like it's going to be okay, but really we're set up well for 2021. To that extent, we've gone ahead and bought those equipment, those servers, the truck, whatever that would be. In that scenario, we might look at it and say, hey, while we could take the bonus depreciation or the Section 179 deduction, we might be actually better off in not doing that and saving up some of those deductions, some of those depreciation deductions going forward into maybe a better year for 2021. The really great part about that is that as long as you're buying that equipment for economic need, because you really need it in your business, we can make the decision about how it's going to be depreciated later, right, when we come to the tax return. So whereas if we say, hey, you need to pay your rent a month early and you pay the rent, the cash is out the door, that's a deduction. In these kind of asset acquisition scenarios, we may actually have some flexibility later on as the world becomes more clear. So I think the takeaway there is always that the asset should be acquired for genuine economic need, right, because you actually need it. So if we take a look at the next slide here. In the case of partnerships, some of the things, again, to kind of touch on some things that Jim mentioned and then go a little bit deeper into it. Over the past few years, we've really seen a push for partnerships to periodically reevaluate their structure. And one of the things we've seen partnership entities do is go away from guaranteed payments. Guaranteed payments conceptually in the partnership law basically go back and say, this is how partners in a partnership are compensated for their time or their elbow grease, their sweat equity. So rather than take a W-2 and take payroll, which partners in a partnership are not allowed to do, the tax code, the tax regulations allow for this guaranteed payment. Unfortunately, that guaranteed payment does not increase profitability for the qualified business income, the QBI deduction. And now that we're looking at, for many of our Maryland-based entities, the Maryland pass-through entity deduction, another 8% deduction, the guarantee payment also is not eligible for that treatment. So if we have a partner in a partnership who is compensated $100,000 and that's treated as a guaranteed payment, it's a $100,000 deduction to the partnership, so it decreases the partnership's profit by $100,000. Thus making the partnership ineligible for a 20% federal deduction for the QBI and an 8% federal deduction based on the Maryland PTE election. So that can be really costly. And so what we've seen many clients do is go ahead, talk with their attorneys, talk with their accountants, understand the facts and circumstances, and essentially take out the guaranteed payment and replace that with some sort of preferred profit allocation to the partner in question. There are certain rules, and certainly a law firm or a lawyer would be better suited to discuss what those rules would be. But essentially, given the right facts and circumstances, you can now create a 28% tax deduction at the federal level for that same $100,000. That really can make a significant savings when the numbers scale up. What other considerations might we look at? Let's take a look at the next slide. So S corporations might also take a few minutes to look at reasonable compensation. This is always a little bit of a tricky situation. S corporation shareholders generally have entered into the S corporation in order to take some modicum, some sort of minimum amount of salary, and then limit the payroll tax expenses above that. However, reasonable is not defined in the tax code. And so in 2020, in a year that's been as crazy as it has been, it might be a natural time to look back and say, okay, I now have my S corporation shareholder taking a salary of X, if that's 150,000. Does that make sense? Is this a year where that person, if they were an outside party, would have 150,000? Maybe this is a year in 2020 where had this person not been an owner, we actually would have cut salaries, or we would have maybe laid that person off. Hey, maybe it makes sense for the owner to take a lower salary. And what does that do? It decreases payroll taxes. It also increases the profit in the company for, again, those QBI deductions. They're can be super nuanced, where you're sort of looking at a wheels within wheels scenario. So you really want to look to your tax advisor and say, hey, this is something I'm seeing. This has been a down year. Maybe we should just review what is reasonable compensation. So next, we'll take a look at the next slide here. So what are some potential pitfalls? And these are the tricky ones. So for cash basis taxpayers, the potential pitfall is a scenario where you're looking at your books and they say you've made a loss or you've had a bad year, maybe you're break even. And the tax folks come back 6 weeks after year end and say, okay, well, you've got X $100,000 profit and you owe taxes. And you say, well, how can that be? I'm looking at my books and it says, that I have a loss or I'm break even. Well, on the cash basis, you have to remember that at the end of 2019, we deferred any income that we hadn't received. And we accelerated any expenses that we paid at the end of the year. Well, those sort of come into the beginning of 2020, and the first cash flow we receive is bringing up cash basis income. And January, maybe even February of 2020 might have been good months. And as we go throughout the year, then on accrual basis, we're having less billings and less accounts receivable. And we're seeing not a great year, but we have to remember that we had that first sort of hit of income that can be sort of throw things out of whack. So in any year where hey, I'm keep my books on accrual basis, but I'm taxable on a cash basis. When you look at the end of the year and you look at trends and you look at if AR is flat or if AR is down, and if accounts payable are flat or up, those are scenarios when we really need to take a little bit of time and look at, hey, what does that mean from a cash basis? Because that's where we see folks who might have taken distributions just like they always do, and all of a sudden the tax folks are coming back and saying, hey, either you don't have basis for your losses or you have a taxable capital gain on distributions in excess of basis. Those are both fairly technical topics, but really important things to consider. Normally, we would say, hey, this doesn't really affect accrual basis taxpayers, but it could. Some expenses for accrual basis taxpayers have to be paid within 2.5 months of year end by 3/15. Other expenses have to be paid by the filing of the tax return. If, and gosh, I don't know, but if things look like they're going to lock down again, if it looks like this winter could be a tough winter for business conditions, and we're looking at, hey, we're going to accrue bonuses at year end and these sorts of things. And then it turns out as we get farther into 2021, that cash flow doesn't support paying those bonuses and we're going to have to, delay those or do something else with them. then again, that's a scenario where even looking at accrual basis books, we're in a scenario where there may be a unwelcome surprise early in 2021. So something to keep an eye on even for accrual basis taxpayers. We'll go to the next slide here. So coming to the end of our section and looking forward to hearing from Michael Bondi, we have another polling question. If you applied for a PPP loan forgiveness, who has approved your forgiveness at this point? How far along the process have we got? Let's see what the results look like. So a lot of folks looks like haven't applied, and for those who have, maybe nobody's gotten around to responding yet. They're probably overwhelmed. Some folks have heard back from the lender, and a few folks have even gotten the whole process. So that's very exciting for those folks. Love to hear that kind of feedback.